So sorry for the wait. I got tied up. I get distracted. Those are my excuses. They're not good ones, but that's all I've got. Anyways, this is a continuation of yesterday's class or lesson. And I think it's probably one of the more important things that I have to talk about, besides the strategy and all. And it is the overall process that I would like you to embrace. And that is this concept of trading campaigns. And if any of you have, I don't know why I'm itchy nose. That's supposed to mean that you're going to get into a fight. So if any of you have followed me for any length of time, you know that I was for 40 years involved in technology, and some of my my expertise lie in the area of process and agile methodologies, that sort of thing. And agile also implies a concept known as continuous improvement. And I know that a lot of traders try to implement something like this. They all come up with their own methodology, but I'm taking a tried and true methodology that has worked in business as well as in development of things, all the way down to manufacturing. In fact, the Toyota manufacturing process is all kind of all of this is a derivative of some of the original work that was done with Toyota and their Kanban process and Kaizen. And I've talked about that before, and other people have mentioned it. Anyways, continuous improvement. Basically, the concept is that you break things up into time boxes. Actually, I've got a little presentation. Maybe I should bring that to the forefront. Bring that over here. And let me get the chat out. So in case you want to ask any questions along the way. And I'm going to share the screen. All right, so campaign trading, conducting a retrospective. The retrospective, which is what I called our meeting on Saturday, and then the follow-on yesterday, is that part that actually creates the continuous improvement process. But let me just sort of outline what campaign trading actually is. It's a campaign, and much like there are military campaigns or political campaigns, they have a time that they start and a duration where they have a conclusion. Now, most campaigns are kind of one-time deals. These campaigns that we're running are continuous. They keep on going forever until you either run out of money or you decide you don't want to trade anymore. But what I've decided to do is, excuse me, is to have these campaigns in the spirit of agile. Man, itchy nose, things getting stuck in my throat. In the spirit of agile, to break them up into small definitive time blocks, or time boxed as we call them. And those boxes that span, in agile they call those sprints, but in this case I'm going to call them campaigns. They have a beginning and an end and a middle, obviously. In the beginning, you start off a campaign with a general strategy, an allocation of funds, the things that you're going to trade, right? and as well as anything that you've learned along the way that helps you, conduct that business for that coming campaign. So then you conduct the business of the campaign, right? And you track what happens, and you keep good, records, trade records, that sort of thing. We do that here in the room by just keeping track of everything that we do. And then at the end of that campaign, you have a period where you need to just evaluate everything that you did. And that's called the retrospective. It's one of the reasons why we have Saturday meetings. The Saturday meetings are meant for two things. They're kind of mini retrospectives for the week, and then also combine that with lessons that we learn so that we can carry it on to the next day. And then at the end of the month, we'll have this sort of big retrospective. And that could carry on in maybe a couple of days. It will be, and that's what it's done so far because this is the first time we're doing it. But it was on Saturday, and then on Monday, I continued with it. And now here it is Tuesday. I'm talking about it more because now we're just talking about the whole process. In that retrospective, you evaluate everything that you've done in that campaign. Did you follow your strategy, your goals, the process that you're trying to perfect? Where could you make it better? And what are those things that you could implement in the next campaign? So you take the output of that retrospective and make it the input of the next campaign. So the next campaign, if nothing has changed, is pretty much the same as the first campaign. You continue doing what you're doing unless there are some changes to that, which from our perspective, there's been drastic changes. We're changing up the strategy drastically by reducing the number of strategies that we use down to basically one strategy, and that is credit spreads, and predominantly put credit spreads. All right. And the other thing that we're doing is that we're switching from ETFs to big cap stocks. And we're also employing another internal process or another kind of agile process where we're going to evaluate those stocks and create a watch list, right? We're going to create that watch list. So everything that I'm talking about here, you're seeing on there, right? We're creating that strategy, the allocation, the watch list. I provided you with a graphic like this that says, hey, this is kind of like what we're doing. I've given you a whole bunch of lists, at least 3 lists now to evaluate, which we will then put into this big bin that we'll be watching. And then out of that big bin, we need to extract, 10 to 15 stocks that we're going to really focus on. And every month we'll evaluate that. And some of those stocks may change, some of them may not. And a lot of that will have to do with the nature of the market, right? So if we're on a bull market, we're going to go with the stocks that are going to be most conducive to using in that type of scenario. If we're on a range-bound market, we'll do that. If we're in a down market, we're going to look at maybe more defensive stocks. And any combination of those two as we're transitioning. But for each campaign, we're going to stay fairly static and try that out so that we can get a good measure on the results of what we did. And our score will be the profit that we make at the end of that campaign. Now, let's go back to this here. We're talking about this strategy pivot, what we're doing. Now, first of all, before I go on, does this make sense to everybody? And you can just go into the chat and say, no, this is bullshit, Ernie, or yes, that makes sense. I like it. Let's go forward. And I'm not requiring you to become, instant disciples of campaign trading. I'm just telling you that this is what I'm doing, and you can just sort of play along if you want, or you can become an active participant. All right? Good. I'm glad you all like it. So in this, in that first campaign that we did that was kind of loosely bound, we did pretty good. Probably made about 10%. Not bad. Good way to start. Way above what I had expected. Because look, if we can make 6% a month, then that means that we will double our account at the end of 12 months. 6%, average 6% a month, we will double our initial starting capital every year. If we double our account every year, it won't take long. Let's say if you start out with a $10,000 account, I'm just going to do some quick math, right? Start out with a $10,000 account, you double it the first year, it's 20,000, then 40, then 80, then 160, then 320. In 5 years, a $10,000 account will be on its way to be worth near $500,000. And if you think that that's, pie in the sky, it's not. It's not if we continue doing this and we follow this strategy. All right? So the other thing is, well, is this strategy scalable? Yes, it is. It most certainly is. And it doesn't matter if you start with a 10,000 or even a 2,000. I think below a 2,000 would be undoable, only because you need at least 2,000 with most brokers to get margin, and we need margin in order to sell premium. All right. So the first thing in our strategy pivot is that we're doing the things that I had said. We're moving away from ETFs because they don't have enough premium in them. We're moving away from what I had originally proposed, and that was, natural resources, because we saw what happened with UNG, and that's just something that we can't deal with. I mean, unless we had if we did have a short put spread under that, we would have done great with UNG. But in this case, we chose that lame-ass butterfly that didn't work out. And so we're moving away from all those butterflies, iron condors, all that bullshit, and just going simply with put spreads and put credit spreads and call credit spreads. Call credit spreads will be in the case where we think we're going to have a down market. And that's it. We're going to develop a small watch list. And so I've given you the process around that. Again, we're selling premium. We're only going to trade the best setups. Now, what do I mean by the best setups? Well, the setups that are the best are those things that from a technical point of view or a practical point of view, and you know that I'm not a big fan of technical analysis, so we're going to be very careful about what we actually call technical analysis. And if you know me, you know that volume profile is the way to go, because it is, in my view, the only legitimate technical analysis method. Because first of all, it's not really technical analysis. It's analysis of the actual data that's in the directly from the brokerage or the exchange. And it can tell us where those trading ranges are. So we can also use things like Thomas Bulkowski's pattern site as sort of confirmation for different patterns that we see from a time perspective that have real edge. I'm only interested in things that have real edge. And we're going to use those two tools, primarily volume profile, to find where's the best place to take an opportunity. And that's what I did with IBM. I found that there was an opportunity to put a put spread under there because volume profile kind of dictated that that was like a good area of support. And the next part about this strategy pivot thing, if you look at the fourth one down, patience is gold. I'm not just going to throw the trade on, which in the beginning that was like, hey, let's just find these things and we'll just throw them on. Who cares if you go in, wherever it is, who cares? All we care about is collecting the premium because we have edge, which is all still true. But now we're going to increase those odds even more by putting these trades on at the right spot. Okay? And that means that putting them on places that are at the boundaries of volume nodes and volume wells. That only makes sense. All right? And the last thing in that strategy pivot is, and this is all things that we're going to be putting into this next campaign. That's right. It's all about maximizing profit and maximizing profit and probability of a winner. I want to bring that probability up from 80% to 95 to 90. I want to bring it up to 100%. And I think that that's definitely possible with this type of trading methodology. We're going to do our trades in the last half of the session towards the end of the day. That's what EOD means, end of day. And the reason for that is that in the beginning of the day, you have a lot of volatility. In the middle of the day, it will either establish a trend or it will consolidate. At the end of the day, it will kind of either confirm the beginning of the day and the middle of the day, or it will establish something new. So that's why we wait there. It's like the confirmation of the day, and that's when we will take our action. So that's why patience is gold. It will give us the best opportunity. Yes, so end of day is like 3 to 4 p.m. Eastern time, I would say. For those people that are outside of the, this time zone, I don't know what to say. You're trading the U.S. market, so, you adjust your sleep patterns. Same way that my mentor, he lived in Hawaii, and he, completely adjusted his sleep patterns for that. And I know that people that are in Europe are doing the same. And that's just the way it is. So I don't have any sympathy if you're saying, well, it's the wrong time for me to trade. You just adjust your day. That's all. It's not that hard. Depends on whether or not this is what you want to do. And this is not a full-time job either. That's the other thing. If we perfect this process, there's no reason why you should have to spend any more than a half an hour a day on this, unless you just like hanging out with guys online and talking with them, which is very possible, right? I mean, I like it. That's why I'm here all the time, but I'm here really to provide support for everybody and try to build the business. So that's my excuse. Your excuse is equally as valid. All right. So that's the pivot. Let's see. What was the next slide that I have here? Oh yeah. Well, this is the kind of watch list mentality, the watch list goals. We want to diversify the list so that it will match a cross section of a few different types of possible markets. We have trending, consolidating, and declining markets. So we want at least enough things in there that can hit most of those things. We'll weight it to what the prevailing market is, because we have different time frames. In the monthly and yearly time frame, we might have one market. In the daily, weekly time frame, we might have a different market. So we don't know exactly how it's going to act. So we have this kind of diversity of, good, strong stocks. And we look for and set alerts where we think that would be good places to enter. And then when those alerts trigger, we say, like the IBM one triggered for me yesterday. And I said, okay, let's take a look at that today, and we'll look at trading that. Now, this is just an example. I'm not even saying that IBM is going to be on our list, but it's probably a good candidate. Maybe the FANG stocks are on our list. Maybe some more defensive stocks. I don't know. And that's what we need to do. We need to come up with what that list is. But I think the one bit of criteria we can use is that the stocks have at least a $50 billion in market cap. That kind of assures that they're a big enough company that, all the news that is out there is kind of baked into the price. There's really nothing out there that's going to really cause it to, go haywire for the most part. And for that reason, it's going to be relatively stable. We're going to need about 15 of these to be active, and then we'll evaluate that at the end of each campaign in our retrospective. All right, and of course, this is that process that I'm talking about in evaluating the stock watch list. And if you have ones that you want to throw into the big observe and rank portion of this life cycle, let me know. Just as long as it's a leader in its market and probably, around 50 billion or more in market cap and is very liquid, then it's probably a good candidate. And how does it stand up against the other stocks that we have in there? Is it diversified enough? Another way to say it is it uncorrelated enough with the others? Okay. So hopefully all of this makes sense. That's really all I wanted to say. Let me get the big head back here. Big head back. I want to thank everybody that that came out and waited for me. I'm very sorry to make you wait. If you have any questions right now, let me know. Otherwise, we'll move on. So I'll give you a minute to think. All right. So again, I am not requiring you to become a campaign maven, but I want you to know that that's what I'm doing and that I recommend it. And the whole purpose of it is to have this complete life cycle that is all geared around continuous improvement of our process. That's what we're doing. We don't have goals because goals are nothing but a point at which you hope to achieve, and in the process, you're in a perpetual state of losing. You're not at that goal. We are all about developing the process, and then if that process gives us the kind of return that we want, we're going to keep on doing that and try to make it better. How about a very specific time for end of day, 3 p.m. Eastern Standard, so we have time? I'm not sure exactly what that means, but end of day is, you know, the last hour of trading is 3 p.m. So 3 to 4 is probably, you know, where you're most likely to make your trade. That's where I'm going to look at. Does that mean that we can't make a trade at 255 or 250? No, of course we can. I'm just saying that what we need to do is probably just start looking at these things at the end of the day. You know, you can glance at it during the day and then see where it is and see whether or not it met our criteria for getting into that trade rather than jumping on it in the beginning of the session, which is what we did with UNG, and I regret that. All right. All of this is about making this better, making us more profitable, to win more, be happier, and win. Just win. We're going to win. All right. Now I'm done. Thank you very much. We'll see you next time. Bye.